Hey everyone, let's break down what's happening with the US economy right now, in simple terms. If you've even wondering why your mortgage rates are high, or what's going on with the stock market, this video is for you. So, the big player here is the Federal Reserve, or the Fed. Their main job is to keep inflation in check. Recently, they decided to hold interest rates steady, instead of raising them again. Why were rates so high in the first place? To fight soaring inflation, think of high interest rates as the economy's brake pedal. By making it more expensive to borrow money, the Fed cools down spending, which helps bring prices back under control. This directly affects you through higher mortgage rates, car loans, and credit card interest. It's a tough pill to swallow, but it's the Fed's tool to stop prices from spiraling out of control. Now, let's look at the last 30 days. The latest inflation numbers, the CPI, showed that inflation is still a bit sticky, especially core inflation, which strips out volatile food and energy prices. It's not falling as fast as we'd like. On the bright side, the job market is still holding up surprisingly well. We're seeing steady job growth, which is great news because it means people are still earning and spending, keeping the economy from stalling. What about the stock market? It's been a bit of a roller coaster. The S&P 500, Nasdaq, and Dow have seen some ups and downs, reacting to every piece of economic news. Big company earnings reports have been mixed, and consumer spending is solid but cautious. The big debate right now is whether we're heading for a soft landing, where the economy slows down just enough to beat inflation without causing a recession, or if a recession is still a risk. So, what does this all mean for your wallet? For housing, mortgage rates are likely to stay elevated for a while, making home buying challenging. Your credit card debt is more expensive, so it's a good time to pay it down. On the plus side, high interest rates mean you can finally earn some decent interest on your savings accounts. For your investments, the market might remain choppy as it figures out the Fed's next move. Looking ahead, what are the experts saying? Most believe the Fed is done hiking rates. The big question is when they will start cutting them. Some are betting on cuts later this year, but it all depends on inflation data. The risk of a mild recession is still on the table, but a soft landing seems more and more likely. In short, the Fed is carefully balancing fighting inflation without crashing the economy. This means borrowing costs will stay high for a bit longer, but there's hope for relief on the horizon. For now, focus on managing debt and taking advantage of higher savings rates. Thanks for watching, and be sure to subscribe for more updates.